Listen, I want you to picture something. A Tuesday morning in September of 2025. A conference room in a financial planning office in Charlotte, North Carolina. His name is Gary. He is 63 years old. He spent 31 years as a manufacturing engineer at a large, publicly traded industrial company, the same company his father worked at. He started in the mailroom at 22, went to night school for his engineering degree, and worked his way up. Along the way, he participated in the company's 401k plan. He contributed every year. He took the match. He invested in the diversified options the plan offered. And he also accumulated company stock inside the 401k. Not because he was reckless, because the company's matching contributions came in the form of company stock, and because over 31 years he periodically bought additional shares through the plan's employee stock purchase feature. Gary retired in June of 2025. He sat down with his financial planner 3 months later to discuss rolling the 401k into an IRA. The planner pulled up the 401k statement. The account holds $920,000 total. Of that $920,000, approximately $340,000 is in company stock. The cost basis on the company stock inside the plan, meaning what Gary originally paid for those shares through payroll contributions, and company matches over 31 years, is approximately $67,000. The current fair market value of those shares is $340,000. The net unrealized appreciation, the NUA, is $340,000 minus $67,000, which equals $273,000. Gary's planner looked at the statement. The planner said the rollover to the IRA is the standard approach and walked through the process for rolling all $920,000 into a Vanguard IRA. The rollover was straightforward. The money moved. The 401k closed. The IRA opened with $920,000 in it. Gary walked out feeling like the meeting had accomplished what it needed to accomplish. What the meeting did not accomplish is a conversation that Gary will spend the rest of his retirement wishing had happened before the rollover was processed. Because there is a provision in the Internal Revenue Code called Net Unrealized Appreciation Treatment under Internal Revenue Code Section 402(e)(4). A provision that has been in the tax code since 1969, a provision that Gary's planner had either never encountered in meaningful depth or chose not to raise before processing the rollover. A provision that, if it had been applied to the $340,000 of company stock in Gary's 401k before the rollover, would have saved Gary and his heirs between $150,000 and $200,000 in lifetime tax, depending on how long he lives and what happens to the stock price after distribution. The rollover to the IRA is now complete. The company stock is no longer company stock. It is IRA assets. The NUA opportunity is gone. Permanently. Irrevocably. Because the NUA treatment requires that the company stock be distributed in kind from the qualified plan as company stock, not sold inside the plan and then distributed as cash, and not rolled into an IRA. The moment Gary's planner processed the rollover, the $273,000 of net unrealized appreciation that could have been taxed at the 15% long-term capital gains rate was converted into ordinary income that will be taxed at 22% to 24% or higher when Gary eventually takes distributions from the IRA. That is the NUA opportunity, and it is the most consistently overlooked tax planning provision in the retirement distribution landscape because it is counterintuitive, because it requires the financial advisor to recommend not rolling assets into the IRA that the advisor is about to manage, and because the window to use it closes permanently the moment the 401k assets are distributed in any form other than the specific in-kind stock distribution the statute requires. Smash the like button right now. The financial services industry has a structural incentive to roll 401k assets into IRAs that the advisor manages, because the IRA generates ongoing advisory fees and the NUA distribution removes the stock from the managed account universe permanently. Every like on this video puts this analysis in front of one more 401k participant with company stock who is approaching retirement, and who still has the window to use the provision before the rollover closes it forever. Hit it, subscribe, flip the bell. The suits in legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of Internal Revenue Code Section 402(e)(4). and what it does for the 401k participant with significant company stock holdings who meets the triggering requirements before retirement distributions begin. Consult a fee-only fiduciary and a CPA who has modeled NUA treatment for clients with qualified plan company stock. What I can do is show you the math and the mechanism. Let me start with the statutory foundation. Because the NUA treatment is built on a specific set of rules that must all be satisfied simultaneously, or the provision does not apply. Internal Revenue Code Section 402(e)(4) provides that when an employee receives a lump sum distribution from a qualified employer plan, the net unrealized appreciation in employer securities included in that distribution is excluded from the employee's gross income at the time of distribution. The exclusion is conditional on several requirements. The distribution must be a lump sum distribution, meaning the entire account balance must be distributed in a single tax year. The distribution must be triggered by one of 4 qualifying events: death of the employee, attainment of age 59 and a half, separation from service, meaning leaving the employer, disability for self-employed participants. For Gary, the separation from service in June of 2025 is the qualifying triggering event. He left the employer. He is over 59 and a half. He meets the triggering requirements. The distribution must include the employer securities, meaning the actual company stock shares must be distributed in kind from the plan. The shares cannot be sold inside the plan before distribution. The shares cannot be rolled into an IRA. They must come out of the plan as physical or electronic shares of company stock, distributed directly to a taxable brokerage account. When the employer securities are distributed in kind as part of a lump sum distribution, 2 tax events occur. First, the cost basis of the shares inside the plan is treated as ordinary income in the year of distribution. For Gary, that is $67,000 of ordinary income in 2025. Second, the net unrealized appreciation, the $273,000 difference between the fair market value and the cost basis, is not taxed at distribution. It is excluded from income under Section 402(e)(4). The NUA is taxed later, when Gary sells the shares. When he sells, the gain is taxed at the long-term capital gains rate, regardless of how long Gary has held the shares after the distribution, as long as the shares were held inside the qualified plan for the required period before distribution. The long-term rate applies to the NUA portion, even if Gary sells the shares the day after they are distributed from the plan. Now let me model the tax comparison in real numbers. The Gary who rolled everything into the IRA versus the Gary who used the NUA provision on the company stock. Gary who rolled into the IRA. All $920,000 rolls into a Vanguard IRA. The $340,000 of company stock becomes IRA assets. Every dollar of every future IRA distribution is ordinary income. When Gary takes $340,000 out of the IRA over the course of retirement in distributions taxed at his marginal rate, the total federal and North Carolina state income tax on those distributions is approximately $93,500 to $108,000, depending on the distribution timing and the bracket interactions. Gary, who used the NUA provision. Before the 401k closes, Gary requests a lump sum in-kind distribution. The $580,000 in non-company stock assets rolls into the Vanguard IRA as normal. The $340,000 of company stock is distributed in kind as shares into a taxable brokerage account at Schwab. In the year of distribution, Gary recognizes $67,000 of ordinary income, the cost basis, which is taxed at his 22% federal bracket, plus North Carolina's 4.5% state rate. Federal and state tax on the $67,000 ordinary income, approximately $17,685. Gary now holds $340,000 of company stock in his taxable Schwab account with a stepped-up cost basis equal to the fair market value at distribution, $340,000. Wait, the NUA, $273,000, is not taxed at distribution. It is deferred. When Gary sells the shares, the $273,000 of NUA is taxed at the long-term capital gains rate. Federal long-term capital gains rate at Gary's income level, 15%. North Carolina state capital gains tax at 4.5% as ordinary income. Combined rate on the NUA at sale, approximately 19.5%. Tax on $273,000 at 19.5%. Approximately $53,235. Total tax on the $340,000 of company stock using NUA, $17,685 at distribution, plus $53,235 at sale, totaling $70,920, compared to $93,500 to $108,000 for the same $340,000 distributed through the IRA as ordinary income. NUA savings, approximately $22,580 to $37,080 on the current value alone. But the comparison does not end at the current value. It extends to the appreciation after distribution. When Gary holds the company's stock in the taxable account after the NUA distribution, any additional appreciation above the $340,000 fair market value at distribution is taxed at long-term capital gains rates when eventually sold. The same additional appreciation held inside the IRA would be taxed as ordinary income when distributed. For every dollar of future appreciation, the NUA account generates a 15% federal capital gains rate. The IRA generates a 22% or higher ordinary income rate on the same appreciation. If the company stock appreciates by another $100,000 over the years Gary holds it, the NUA account produces $15,000 in federal tax on that gain. The IRA produces $22,000 to $24,000 in federal tax on the same gain. The NUA advantage compounds with every dollar of future appreciation. And there is a final dimension that amplifies the NUA advantage dramatically: the step-up in basis at death under Internal Revenue Code Section 1014. If Gary holds the company's stock in the taxable account until his death, his heirs receive a step-up in basis to the fair market value at the date of death. The NUA that was taxed at the 15% long-term rate during Gary's lifetime is the only component that carries a tax cost. Any appreciation after the distribution date that Gary never sold and never paid tax on is eliminated by the step-up at death. The heirs inherit with a clean basis at the date of death value, zero capital gains tax on the post-distribution appreciation. The same assets inside the IRA would be inherited as a traditional IRA, subject to the Secure Act 10-year distribution rule, taxed as ordinary income at the heir's marginal rate across 10 years of forced distributions. The NUA account with the step-up is materially superior to the IRA distribution for the heirs. Tell me in the comments right now. Tell me whether your 401k or employer retirement plan holds company stock. Tell me the approximate current value of the company stock inside the plan and your best estimate of the original cost basis if you know it. Tell me how many years you have until retirement or separation from service. Tell me your state. Drop the numbers in the comments. I read every single one. We calculate the NUA opportunity together, and the number may change the plan you are executing for retirement. Now let me walk through the 4 strategic considerations that determine whether the NUA treatment is the right choice for a specific participant's situation. Consideration 1, the cost basis percentage. The NUA provision is most valuable when the cost basis inside the plan is low relative to the current fair market value. A low cost basis means a high NUA and a large amount of appreciation that can escape ordinary income treatment. For Gary, the cost basis is $67,000 on a $340,000 position, meaning 19.7% of the value is ordinary income and 80.3% is NUA, taxed at capital gains rates. That is a favorable ratio. If the cost basis were $250,000 on a $340,000 position, the ordinary income component at distribution would be $250,000, and the NUA would be only $90,000. The tax on $250,000 of ordinary income at 22% plus state would be approximately $65,500. The NUA advantage narrows significantly when the cost basis is high relative to the current value. The NUA provision is most powerful for participants who accumulated company stock over long periods with low average cost per share, or through matching contributions that established basis at prices significantly below the current market value. Consideration 2, the current income level in the distribution year. The ordinary income recognized at distribution, the cost basis, is taxed at the participant's marginal rate in the year of distribution. If the participant can time the NUA distribution in a year of lower income, the cost basis component is taxed at a lower rate, improving the overall economics of the strategy. Gary retired in June. His income for the second half of 2025 is reduced because he is no longer earning his full salary. The NUA distribution in 2025 happens to land in a relatively lower income half year. Consideration 3. The concentration risk of holding a large single stock position in the taxable account. The NUA strategy requires holding the company's stock in a taxable brokerage account after distribution. If the stock is held in concentration rather than diversified, The portfolio is subject to single stock volatility risk that a diversified IRA would not carry. The solution is not necessarily to sell the entire NUA position immediately, which would recognize the full $273,000 NUA at capital gains rates in a single year. The solution is a staged diversification strategy. Gary sells a portion of the NUA position each year, recognizing a portion of the NUA at capital gains rates in each tax year, keeping the annual capital gain recognition below the threshold that triggers the higher rates. The NUA, treated as long-term gain in each sale year, is also taxable in a way that interacts with the Social Security provisional income calculation. Gary's staged NUA recognition should be coordinated with his Social Security claiming strategy to manage the combined provisional income and IRMAA impact. Consideration 4. The interaction with the rest of the retirement account. The NUA strategy requires a lump sum distribution of the entire plan balance in a single year. The $580,000 in non-company stock assets rolls into the Vanguard IRA tax-free under Section 402(c). The $340,000 of company stock distributes in kind to the taxable brokerage account, triggering the $67,000 ordinary income. The overall retirement account architecture after the NUA distribution is a combination of a $580,000 traditional IRA and a $340,000 taxable account holding company stock. That is a more complex distribution sequencing problem, but it is a problem with more tools available. The taxable account provides liquidity at capital gains rates. The IRA provides liquidity at ordinary income rates. The Roth conversion strategy can be applied to the IRA portion to reduce future RMDs. Let me now give you the geographic dimension, because the NUA advantage varies significantly by state due to the different state tax treatment of long-term capital gains relative to ordinary income. In North Carolina, where Gary lives, the state income tax rate is a flat 4.5% applied to all income, including long-term capital gains. There is no preferential state capital gains rate in North Carolina. In Texas, there is no state income tax. The NUA advantage is the full federal differential between the 15% long-term capital gains rate and the 22% to 24% ordinary income rate. On $273,000 of NUA, the Texas advantage is $273,000 times 7% to 9%, equaling $19,110 to $24,570. In California, long-term capital gains are taxed as ordinary income at California's standard income tax rates, which reach 9.3% at income levels comparable to Gary's. The California NUA advantage is smaller than in most other states. In states like Colorado, Oregon, and Montana that tax capital gains at lower rates than ordinary income, the NUA advantage is amplified beyond the federal differential by the state preferential treatment of capital gains. In Washington state, the 7% capital gains tax on gains above $262,000 affects the NUA strategy for participants with NUA amounts above the threshold. Gary's $273,000 of NUA in Washington would generate approximately $770 in Washington capital gains tax. Now let me give you the 5-step action sequence. What a 401k participant with company stock does before the rollover is processed to evaluate and potentially execute the NUA strategy. Step 1. Pull the 401k statement and identify the company stock allocation. Confirm the current fair market value of the company stock inside the plan and the cost basis. Step 2. Calculate the NUA ratio. Divide the cost basis by the current fair market value. If the ratio is below 50%, the provision is potentially worth modeling in detail. If the ratio is below 25%, the NUA provision is almost certainly superior to the full rollover. Step 3. Engage a fee-only fiduciary and a CPA to model the complete tax comparison. The model must include the ordinary income tax on the cost basis, the step-up in basis benefit at death, and the concentration risk. Step 4. If the NUA strategy is superior after the complete modeling, request the lump sum in-kind distribution from the plan administrator before processing any rollover. The lump sum distribution request must specify that the employer securities are to be distributed in kind as shares. Step 5. After the distribution, develop the staged diversification plan for the NUA position in the taxable account. Calculate the maximum capital gain that can be recognized each year while staying below the 15% federal bracket. Execute the diversification over multiple years. Save this video to your private library right now. Hit the bookmark. Add it to the retirement survival playlist. Because the NUA window closes the moment the 401k assets are distributed in any form other than the in-kind stock distribution. The company's stock that should have been distributed in kind under Section 402(e)(4 is a long-term capital gains opportunity waiting to be used. The difference is approximately $22,000 to $37,000 of federal and state tax, plus the step-up benefit at death. Gary's planner processed the rollover before asking the NUA question. Gary is going to spend several years with a financial planner who never told him about the provision that could have saved him between $50,000 and $180,000 in lifetime tax. Subscribe if you have not. Flip the bell. Comment with the amount of company stock in your 401k and your approximate cost basis if you know it. Tell me your state. Tell me how many years you have before retirement. We run the preliminary NUA calculation together. Section 402(e)(4 has been in the tax code since 1969. It is not a loophole. It is not aggressive tax planning. It is a provision that Congress wrote specifically to allow employees who accumulate employer stock to benefit from the long-term capital gains rate. It is the system working for the employee. The financial planning industry's incentive structure works against surfacing this provision because the in-kind distribution removes the stock from the advisory account permanently. That is not a reason to leave the provision unused. That is a reason to find an advisor who will tell you about it anyway. Find that advisor. Before the rollover. Before March. Before the window closes and the $273,000 of NUA becomes ordinary income in an IRA that someone will eventually distribute at 22% or higher. The provision is available. The window is open. Use it. I will see you in the next one. Stay strategic. Stay furious. The NUA opportunity was written into the code in 1969 for people exactly like Gary. Gary deserved to know it existed before the rollover was processed. Now you know. Act accordingly.